in some ways, Constance, at a headline level, this looks like a good report. Do you think it's a good report?
Well, look, we made progress, and that's an important thing. We didn't backslide. And as you mentioned about the whisper number, it was a very wide range, and there had been a lot of noise coming from a variety of different data sources leading into this number. So we had the Census Bureau's weekly pulse survey, which ended, but it went through the reference week, which was suggesting a decline of several million jobs. We had the home-based data, which was starting to show a flattening out of people reporting to work in key service industries. Then we had the unemployment claims, which continue to be in the millions every week. So leading up to this data, there was a lot of reason to suggest that the pace of increase had slowed. And in fact, what we see in this data is, of course, it has slowed. But the good news is that it is continuing. And it is continuing despite some slowdowns that we're seeing around the country as a result of an increase in cases. But just to put this all in perspective, right? If we take our levels, because there's you can look at this via level, you can look at this via percent change, you can look at it then at the second and third derivative. So if we just look at levels, right, on a percent change basis from the peak, we're down 8.1% on GDP, and we are down 8.8% on jobs. Right? So that is still a big hole in the economy. This unemployment rate the level that we're at of slightly above 10% is where we were in the peak of the global financial crisis. So the question that needs to be asked now is, what part of the economic damage that we're seeing is COVID induced, and what part is general recession induced? As we have a recession that goes on longer, consumption slows, that starts to impact other parts of the economy that aren't at the nexus of the COVID impact.
You know, Constance, it's great. You mentioned levels and first and second derivatives, and it's only 11 a.m., so that's pretty good for me, at least for a Friday. Talk to me then about those levels and those first derivatives going out forward, because I keep hearing that we're bound to slow down just a little bit, and this might be one of the last good reports that we see. What does your analysis tell you?
So one of the indicators I love to look at is the diffusion index, which tells you about the breadth of the jobs change. And so the diffusion index was at 75 in June, indicating that we had a very broad increase in jobs growth. And of course, that was a big increase. We got back almost 25% of the jobs that were lost in March and April combined. And if we look to where we are now, that diffusion index has fallen from 75 to 61.4. And so you see that breadth is shrinking. And unless we get the virus under control, I would expect us to remain in this lower breadth of jobs gains. And in fact, I think there's some worry that it could fall slightly again as we fail to ring fence the problems of the virus and as it starts to spread out into larger parts of the economy. So we see that also in the percent of employees that are temporarily unemployed versus permanently unemployed. That permanently unemployed number is ticking higher, and the percentage of those that are temporarily unemployed is falling. So there's definitely room for concern and worry. And again, what's driving that concern is the virus. If we got a vaccine tomorrow and we could manufacture and distribute that vaccine by the end of September, right, we would all have a very, very different outlook. So there's the part of the economy that's being dictated by the virus, and then there's the part of the economy that's being dictated by the ongoing recession that is caused from the virus. And it's those two factors that we're thinking about when we're thinking about forecasting what's going to happen.